Hey everyone, and welcome to AI Explains ICT. Today, we're jumping into a really powerful idea from ICT's core content, specifically Month 5, Episode 8. We're going to uncover how the biggest funds on the planet, the real smart money, find their next massive long-term trade. And believe it or not, it all comes down to following this one thing, a global money magnet.
So you gotta wonder, right? Where do these huge institutions, the ones we call smart money, even start looking? I mean, they aren't just guessing or throwing darts at a map. They have a very systematic, a very fundamental starting point that guides literally every single one of their big long-term moves. So, what is it?
The answer is, well, it's actually beautiful in its simplicity. They follow the yield. Yep, that's it. See, at its very core, all that global capital, all that big money, is just constantly searching for the best possible return on its investment. And the most basic, the most fundamental form of that return, it's interest.
All right, so here's how we're gonna break this all down. First, we'll get into what this global money magnet is all about. Then, we're gonna build a fundamental framework that you can actually use. After that, we'll walk through two really clear case studies, one for buying strength and one for selling weakness. And finally, we'll wrap it all up by showing you how you can use this to build your own long-term edge.
Okay, first up, the global money magnet. Let's really talk about this. You honestly can't get any more fundamental than this. It all comes down to interest rates. Think about it. Large funds are always going to look to move their money from a currency that pays them practically nothing to a currency that pays them more. It's just common sense, right? This constant search for higher returns, what we call yield, is the main engine that drives those huge currency flows over the long haul.
And this right here, this table is the foundation for everything. It's the whole starting point for any kind of macro view. What you're looking at are the interest rates set by the world's major central banks. And according to ICT, this is square one. This is where any long-term analysis has to begin. Just a quick glance, and you can instantly see which countries are paying you more to hold their currency, and which ones are paying you less, or, in some cases, even charging you for the privilege.
And that brings us to the key concept for this entire video, the interest rate differential. It's exactly what it sounds like. It's just the difference in interest rates between two countries. But look, this differential isn't just some boring number on a spreadsheet. It is the fundamental reason. It's the why behind massive, large-scale capital flow. This is what smart money exploits. They buy the currency with the high rate, they sell the one with the low rate, and boom, they've just created a long-term position.
Okay, so how do we take this idea and turn it into something we can actually use? A repeatable process? Well, let's build out a fundamental framework. This is how you can start to spot those high-probability long-term trade ideas and really get in sync with that big institutional money flow.
And the process that ICT lays out, it's just so straightforward. Step 1, you pick a country with a high interest rate. Step 2, you pick one with a low interest rate. Simple. That difference between them, that creates your fundamental bias. Step 3, you figure out the Forex pair. And then step 4, and this part is absolutely crucial, you don't just jump in, no, you wait. You wait for technical confirmation, for clues that smart money is starting to make its move.
All right, time to make this real. Let's jump into our first case study, buying strength. We're going to apply this exact framework to find a reason to be a long-term buyer, and we'll focus on the Australian dollar versus the US dollar.
Okay, so steps 1 and 2. Pick our high and low rate countries. At this particular time, Australia's central bank had a rate of 1.5%, the US just 0.75%. In fact, ICT points out that when this trade was actually setting up, the US rate was even lower at 0.5%. That made the differential even bigger, even more attractive. Right away, this gives us a crystal clear, fundamental reason to want to own the Australian dollar instead of the US dollar. The money is just naturally going to want to flow towards that higher yield.
So, now we have our fundamental bias, right? We want to buy the Aussie dollar. So we head to the charts. For step 4, we're hunting for clues. And this chart just illustrates the next part perfectly. We're looking at a daily chart of the Australian dollar, and you can see prices drifting down right into a major long-term support level. See that old low there, around the 0.7150 mark? This is exactly the kind of key area where you'd expect buyers to be waiting.
And here is where we get our confirmation. It comes from the open interest data. That's the purple line you see at the bottom. Now watch what happens. As price comes down and taps our key support level, look at that sharp drop in open interest. ICT explains this as short covering by smart money. What that means is they're getting out of their short positions and they're doing it fast. Why would they do that? Well, because they don't want to be short anymore. They're anticipating a sharp move higher. This is our smart money clue.
So what happened when you combine everything? You had the fundamental interest rate advantage, you had the key technical support level, and you had the smart money clue from that short covering. The result? Over 400 pips to the upside. See, this wasn't just some random bounce off a line. This was a powerful, fundamentally driven move that we could see coming because we were aligned with that institutional perspective.
Okay, let's really hammer this concept home by looking at it from the opposite direction. For our next case study, we're going to talk about selling weakness. We're going to find a currency that is fundamentally weak and build a case around that. This time, we're looking at the US dollar versus the Japanese yen.
And the interest rate difference here is, well, it's just staggering. The US rate was 0.75%. Japan's rate, it was negative 0.1%. I mean, just stop and think about that for a second. You were literally paying the bank to hold Japanese yen for you. So if you're a massive fund, that makes the yen an incredibly unattractive currency to hold, right? This creates just enormous fundamental pressure to sell it.
Okay, so our fundamental bias is clear. We want to be a seller of the Japanese yen. So we look at the yen's cash chart to find a good spot to sell it from. And here, on this weekly chart, you can see the yen's price rallies right up into a major resistance level. ICT calls this a bearish order block, which is basically just a key zone where we expect big institutional selling to happen. This is our high-probability technical area, the spot where we expect that fundamental weakness to finally kick in and take control.
And that's exactly what happened. Right after it touched that resistance, the fundamental weakness took over and the yen's value just absolutely plummeted. Now you have to remember the key relationship here. When the Japanese yen's own chart falls off a cliff like this, the forex pair USD/JPY does the complete opposite. It rallies and rallies hard. Why? Because in this pair, a vote against the yen is a vote for the dollar.
And the result to this whole trade idea? A truly massive move, over 1,200 pips. This wasn't just random market noise, not at all. This was a major, long-term trend driven directly by that huge interest rate differential we spotted right from the start. This is the kind of scale, the kind of move you can capture when you align yourself with these fundamental drivers.
So the big question is, how do you take this powerful macro way of looking at the market and make it your own? Let's boil this down to the key principles so you can start applying this long-term edge to your own analysis.
So let's be super clear on a few things. First, this is a long-term strategy. You've got to be looking at daily and weekly charts. Second, you have to combine the fundamental Y, that's the interest rate differential, with the technical when, like a key support or resistance level. This is absolutely 100% not for day trading. This is all about positioning yourself for those big, multi-week or even multi-month moves. And the most important part, it aligns your thinking with the way institutional smart money flows.
And when you do all this, what's the ultimate goal? What does it accomplish? Well, ICT sums it up perfectly. He says, you get yourself in sync with the most significant price moves. Think about that. You stop fighting all the little, random, noisy fluctuations in the market, and you start positioning yourself to ride the really big, significant trends.
So that leaves us with one final question, right? Where is the yield now? And that's our deep dive into how smart money follows that global money magnet. If this video helped you out and gave you a new way to look at the markets, do me a favor and hit that like button. Make sure you subscribe to the channel for more breakdowns of ICT's concepts. And of course, if you have any questions at all, just drop them in the comments below. A real human will get back to you. As always, safe trading.